Hello everyone. My name is Anjani Kumar Khetan. I am based out of Bangalore. Welcome back to our series on lack of exchangeability, wherein I introduce you to the concept of lack of exchangeability as contemplated under the recently amended standards Ind AS 21 and IAS 21 under the IFRS framework. Now we are on part 4 of our series, and in this particular video, we will deep dive into the step number 2 as we have been discussing in the last few videos. In case you have not got a chance to view the other videos in the series, here is the QR code for the playlist. You can go ahead and first listen to those videos so that you will have a better understanding of this particular video. Now, if you recollect, we have already discussed that as part of step 1, an entity needs to evaluate whether the currency is exchangeable into another currency at the measurement date for the specified purposes. And if our answer to this question is yes, of course, you will continue to apply the regular requirement under Ind AS 21 and IAS 21. But the challenge comes when the answer to question number 1 in step 1, if that answer is no, and that's what this amendment seeks to address. So if the answer to this question is no, then the standard as amended requires you to move to step 2, wherein an entity is now required to estimate the spot exchange rate when currency is not exchangeable as determined under step 1. So therefore, at the measurement date, say on the year-end date or the balance sheet date, at the measurement date, an entity is now required under step 2 to estimate the spot exchange rate which meets the objective under Ind AS 21 and of course IAS 21 from an IFRS perspective as given in paragraph 19A. Now paragraph 19A is a newly inserted paragraph which talks about what is the objective of estimating such spot exchange rate. So therefore, whichever method the entity applies to estimate the spot exchange rate under step 2, the overarching requirement is that such estimated rate should meet the objective as contemplated under the newly introduced paragraph 19A, and that is something which we will see in the subsequent slides. Now, the amended standard also gives you 2 options. Then when you are estimating the spot exchange rate, either you can do that by using an observable exchange rate without adjustment. And for this, the relevant literature is paragraph A11 to A16 in the amended standard appendix A. Or alternatively, you may use any other estimation technique if for some reason you are not able to use any observable exchange rate. Of course, this is what we are going to discuss, each of these 2 methodology along with the case study. So how do an entity go about estimating spot exchange rate? 2 mechanics, 2 methodologies, as we saw on the last slide, is what is given. But before we go on deep dive into the methodology, what I referenced to you, paragraph 19A. Now this paragraph 19A stipulates what is the objective of estimating such spot exchange rate. So first, let us look at what paragraph 19A says, and then we will go into the methodology which is recommended or contemplated under the amendment. So paragraph 19A says that the objective in estimating such spot exchange rate when exchangeability between the 2 currencies is elusive, it is not there as already determined in step 1. So if that be the case, your objective in estimating such spot exchange rate under step 2 is that the spot rate you are so estimating should be reflective of what? Should be reflective of the exchange rate at which an orderly exchange transaction would take place between market participants under prevailing economic conditions. So if you look at this definition, this objective, paragraph 19A, you will see that this is very much similar to what you have under Ind AS 113 or IFRS 13, which talks about fair value measurement. Now, this is kind of the objective which is building on those literature, which is the fair value measurement related standard, which is Ind AS 113 under Ind AS and IFRS 13. Now, the standard also gives you that when you are estimating such a spot exchange rate, an entity may use, as I told you, two different methodologies. One, you use the observable exchange rate, but without any adjustment whatsoever if that observable exchange rate meets the objective of paragraph 19A, which is defined here. So, if you have some observable exchange rate which meets the objective of paragraph 19A, then the standard says you can use such observable exchange rate, and for which you will need to apply the guidance given in paragraph A12 to A16. This is something which we'll again detail in the next section along with the case studies. Now, if for some reason this rate is elusive, this rate is not available, then in that case, the entity is permitted to use any other estimation technique as contemplated in paragraph A17. So therefore, the entity may use any observable exchange rate and adjust that observable rate as necessary to meet the estimation objective, again given in paragraph 19A. That means paragraph 19A is the source from which you have to take the inspiration to determine what is your appropriate exchange rate on which you are going to estimate. So, for example, when you are applying this second methodology, you can use exchange rate from even unofficial market. If you remember what we discussed in the previous video, that when you are evaluating the exchangeability, whether it exists or not, we have said one of the characteristics in step 1 is that the exchange rate should emanate from market mechanisms or any other mechanism which create enforceable rights and obligations. It should be from the legitimate market. But here, in this particular case, if you look at here, what the standard tells you, that when you are estimating the spot exchange rate, you may even rope in and use the exchange rate in the unofficial market. But careful, you can't just take the rate which is there in the black market or the parallel market or the unofficial market. That rate is only a starting point for you. You got to adjust them. You got to appropriately adjust them and then arrive at and then estimate what is your estimated spot exchange rate in this particular methodology. Okay, so these are the two broad techniques which have been given. Also, paragraph A11 says that this particular amended standard, it does not specify how an entity estimate the spot exchange rate. It only gives you these principles. It gives you the mechanics or broad framework in the context of the objective in newly inserted paragraph 19A. Now, you read this objective and deploy any of these two techniques, which is most appropriate in a particular case, without the standard categorically mandating what technique, which methodology to be followed. That mandate is not given. Also, there is no hierarchy which is also given. No hierarchy is prescribed in the amended standard. There was a lot of discussion in terms of should there be a prescription in terms of which one should be preferred. So there is no specific hierarchy has been given. Of course, in the larger scheme of things, if exchange rate is determined from observable sources, it will be consistent with the guidance in the fair value measurement standard, and therefore technically that would be preferred. But for all practical purposes, the standard do not give a hierarchy. So the standard setters have decided not to set a given hierarchy of observable exchange rate to use in estimating any spot exchange rate, because even though if the standard would have prescribed a hierarchy, that would generally will have the benefit of increased consistency, because the moment you prescribe a hierarchy, everyone has to follow that particular methodology. However, the discussion went in the direction to say that, see, if you started with the premise that the currencies are not exchangeable, therefore the rate itself is elusive, it is not there. So if that be the case, how you are going to have an observable exchange rate? So it will be very difficult in those scenarios that you prescribe a methodology, because each circumstances will be different. There will be a fairly complex situations which will be there in various particular jurisdictions who are affected by this kind of a situation. So therefore, even if prescription of a hierarchy would have led to increased consistency, but that would have imposed significant additional cost on the entities or the preparers who are preparing the financial statements without providing more useful information. Because if you mandate, those rates may not be actually available in a particular jurisdiction. And therefore, the moment you mandate, this rate is something which one need to apply, this method one need to apply, which may not be actually possible in the facts and circumstances of a particular jurisdiction. And that is precisely the reason why no hierarchy has been prescribed under this amended standard. Therefore, while the standard setter have a clear objective, which is 19A, paragraph 19A, for the rate of estimation, but they left the choice. They left a choice on which of these two approaches need to be deployed in real life situation by the entities. In fact, even within this, there are two possible approaches. That is something which we will discuss in the next slides. So even within this broader approach, there are two methodologies which are discussed in the standard. We will look at that, each one of them, along with the case studies. Now, you can clearly see that given these requirements, given this framework of the amendment, obviously it will be judgmental. The entity, when they are estimating, there are a lot of facts, there are a lot of things which they need to really apply and judgment, and then come out with the estimated spot exchange rate. So therefore, you cannot expect that everybody within the jurisdiction will apply the similar set of inputs. They will have to look at their own individual fact pattern and then see which of these is more suitable from their own individual perspective. So using the observable exchange rate, now we are looking at this bit. So in this, as I said, there are two possible approaches one may follow. So if one were to apply this observable exchange rate without adjustment, as I already told you, there are two approaches. First, within this, when you are applying this, one possible approach is that you may apply spot exchange rate for the purpose other than the purpose for which the entity is assessing exchangeability. So for example, let's say your actual purpose is dividend distribution or payment of dividend, for which you need the foreign currency. Now we have seen in the earlier videos that sometimes because of the exchange control requirement, dividend payout, you cannot get foreign currency for the dividend payment. And we have said that the exchangeability in step 1 has to be in accordance with the purpose for which the currency is required. But when you are using this approach, there is a flexibility that even if you are trying to use or estimate the spot exchange rate for the purpose of this dividend payout, you may use import of goods if there is exchange rate available for import of goods, and then it is still you have to apply judgment. Okay, in this case, of course, if these two rates fairly, if they represent the economic conditions on the measurement date, right? In that case, you may possibly use these two rates. That means this rate, exchange rate for import of goods, as a proxy for this dividend payout obligations. But this will be really daunting because you have to apply judgment. So therefore, if you look at in the context of this, some other key callouts which you need to understand what the standard talks about. So in jurisdiction with long-term lack of exchangeability, there may be market mechanisms which do not create enforceable rights and obligations. I already explained this in the previous videos also. So you have a parallel market or a black market, right? Unofficial market, which is there. So you have a scenario that when you have long-term, lack of exchangeability, there does exist a parallel market, and for the purpose of assessing this spot exchange rate, we have seen that for the purpose of assessing whether the currency is exchangeable, in step 1, you ignore the existence of this market, because unless and until the rights and obligations arising out of this market is enforceable, you will ignore these particular existence of those markets, which we have discussed. However, entities they were not permitted to use these, but for the purpose of the applying this particular approach, you may use the rate which is available in this unofficial market, but with a caveat that you have to adjust those. Why would you make an adjustment? So for example, typically when you have unofficial markets, they have a different risk profiles compared to what you have, let's say, an official market. So for example, risk of non-payment in an unofficial market, illiquidity, risk of illegality, there may be certain regulatory framework. All of these can be possible risk which plague this unofficial market. So therefore, there will be, because of the added risk in an unofficial market, you may have so when you have the rates in an unofficial market, that rate will also have a premium for these risks which are being attached in such transactions. So for example, if the parallel market rate is, let us say, 10, and this premium, to take care of this premium, 2 is your 2 currency unit is the premium. So therefore, the exchange rate in the unofficial market will be 12. Now, what this particular estimation technique says, you may start with this 12 as the starting point, but you have to strip out this 2, because these 2 really belong to from the official market perspective. This is a characteristic. This is something which is only specific to the unofficial market, and therefore, though you will start with 12 as the starting point, but you have to do appropriate adjustment in our example of 2 rupee reduction, and therefore the estimated spot exchange rate should be restricted to 10 and not 12. That is the way you have to apply the requirements. So we have already explained to you, once an entity concludes in step 1 that the currency is not exchangeable at the measurement date, thereby requiring you to move to step 2 as we discussed now. Then for such a spot rate in exchange in step number 2, when you are estimating such spot rate in this step 2, entity is permitted to use an observable exchange rate. In my example, that was 12 rupees. Observable exchange rate with necessary adjustment in an, which is characteristics of an unofficial market, right? So that's the way you have to do the, you can apply this particular, methodology. Now, when you are applying these methodology, what are the factors which you need to consider? The standard goes to the extent of saying that when you are applying these methodology, look for these factors. Whether there is more than one observable rate exists. So, for example, if you have a scenario where there are multiple rates exist, one for import of capital goods, one for import of, say, essential commodities, and let us say the other one for dividend repatriation. Now, each one of these rates, from a commercial perspective, may have certain premium or the discount embedded in that. So, for example, for the exchange rate, which is applicable for the essential commodities, maybe that is the lowest rate which you have, because the whole idea of this is that the central government or the regulatory authority wants to make sure that there is not too much of the foreign currency demand in such economy, and therefore you have to look at whether there is one rate or multiple rate which exist in that economy. Then the purpose for which the economy is, for which the currency is exchangeable. Okay, the nature of the exchange rate is the exchange rate free floating, or it is not free floating, rather it is fully administered by a particular agency. And the frequency with which these exchange rates are updated. Are they updated regularly? Let's say every day, or perhaps multiple times in a particular day. Now we will explain all of these by way of the case study in the next couple of slides. So this is one methodology. Second is that you may also use the first subsequent exchange rate at which the entity is able to obtain the other currency for the specified purpose after exchangeability is restored. Let us take a simple example in the timeline. Let us say this is your year-end date, 31st of March, for example. Now, when you are preparing your financial statement at this point in time, exchangeability did not exist. However, let us say in a week's time, let's say on 7th of April, the exchangeability is restored back by the regulatory authorities. So the first subsequent exchange rate, which is exchange rate on 7th of April, potentially you can use that as the exchange rate applicable for 31st of March. But there is a big but, and there is a caveat. You can't just go and apply this. This is your starting point. So this is another alternative, that if you have an exchange rate which is available subsequent to the measurement date in our example 31st of March, and if the rate is available, let us say after a week on 7th of April, then perhaps you can start using that rate as the starting point, 7th April rate as the starting point, and do appropriate adjustment. Because in certain geographies, certain jurisdictions, you may have the situations of, let us say, hyperinflation, which may exist. So when you are applying this methodology, what factors you need to consider? You need to look at the time between the measurement date and the date when exchangeability is restored. In my example, the measurement date was 31st of March, and within a week's time, it is restored. But let us say if it is not a week, it is 4 months. 4 months after the measurement date. That means after 31st of March, April, May, June, July. So end of July only, if your exchangeability is restored. There is a long period here. So therefore, in those cases, it will be highly unlikely that the rate existing on July end, you will take as a proxy for 31st of March. That may not be. Therefore, judgment would be involved. You have to look at the facts of a particular case. Principle is shorter the period. In our example, 1 week versus 4 months. 1 week, which is shorter period. Shorter the period, more likely that the first subsequent exchange rate would reflect situation prevailing on 31st of March, which is the measurement date. Of course, clearly you can see all of these are really, really judgmental. And therefore, when you have judgments, each entity may apply those requirements, these principles in a different way. So when you apply judgment, what is the other fallout? That is something which we will see in the next week's video. That the amendment gives you flexibility, leaves this without mandating which methodology to use. They give only the framework and tells you how to go about it, which possible methodology you can apply, what caveats you need to look at. But then, if you are applying judgment, you have to have a detailed disclosure requirement which need to be also accompanying this particular amendment. Because whatever judgment you have applied in estimating the spot exchange rate need to be properly disclosed in the notes to the accounts. And that is what we will look at in the next video, what additional disclosure requirements are mandated under the standard if an entity is estimating the spot exchange rate by deploying any of these two methodologies. In fact, there is one more. That is what we will see. Any other technique. So, let us look at some of the case studies to explain these concepts. Let's see first. So, here you have a scenario. ABSPL is a foreign operation of Citicorp. Citicorp is the parent. This ABSPL is the foreign operation operating in country A. Now, as of 31st of December 2024, relevant authority in country A, this is the relevant authority in country A, prevents entities from obtaining a foreign currency for the purpose of realizing net investment in an entity operating in that jurisdiction. We have seen that in the last video, that when you are translating the financial statement of your branch or a foreign operation into your head offices of books, then the purpose is realization of the net investment in the entity. Now for that purpose, in this case study, exchangeability doesn't exist because that is not permitted. But other than this restriction, look at the third point. Other than this restriction, entities are able to obtain foreign currency and exchange rate is free floating. That means for this particular purpose, exchangeability doesn't exist, but it does exist for other purposes. And for those purposes, it is free floating. Right? Look at the fourth point. Further, only one exchange rate applies to the transaction in that jurisdiction for the exchange of local currency for foreign currency. And the exchange rate is updated several times a day. These are all the fact patterns which have been given. Of course, I have given the source from where I have taken these case studies and I have made it pictorial, okay, to make sure that we understand. So you have a scenario of parent which has a functional currency euro. The foreign operation is in country A, and in this country, the regulatory authority does not permit the exchangeability of local currency to euro for the purpose of net investment. So clearly, in this case, you can relate to what we have already discussed in the earlier videos as well. That as on the measurement date of 31st of December, for this purpose, entity cannot obtain the foreign currency euro because for this purpose, it is not allowed. Therefore, by applying the requirements of step 1, Citicorp will conclude that the local currency is not exchangeable. Now then what will happen? If it is not exchangeable, you have to estimate by applying step 2. So consequently, the entity is now required to estimate the spot exchange rate as we just discussed today under step 2. Now for that, when you are estimating, don't forget about paragraph 19A because whichever way you are estimating, that is estimated spot exchange rate must be consistent with the requirements and the objective inserted in the newly inserted paragraph 19A. So now the next question is, how do you go about estimating this spot exchange rate? Now we have seen the factors. The standard has given you what factors need to be looked at, right? So let us see. I'll bring forward all those factors which we talked about. These are the factors which we saw in the earlier slide. So when you are estimating the spot exchange rate, you have to ask this question: whether several exchange rates exist, what is the purpose for which the currency is exchangeable, what is the nature of the exchange rate, and the frequency with which exchange rates are updated. Now, we will get answer to all of these based on the facts given in this case. Now, in our case study, the case study says that only one observable exchange rate exists between local currency and foreign currency. Then it also says that Citi Corp is able to obtain foreign currency for any transaction but not for realization of net investment in the foreign operations. Right? So this purpose is not something for which the currency is available. And the currency is free floating. It is all given in the case study itself. And it is updated multiple times in a day. So out of these 4 factors, you will be able to see most of the factors are something which indicate that the objective of paragraph 19A is being met. And therefore, the entity may use, what is the paragraph 19A? I've just brought forward the gist of it one more time here. So therefore, in this case, the parent entity may use that observable rate, which is what? Observable rate here, one single rate, as an estimated spot exchange rate when it translates the P&L and the balance sheet of the foreign operations into its own trial balance or financial statements. So this is one case study. Now, look at the other one about the first subsequent exchange rate. Look at it here. What is there in this case study? It says ABSPL, again, same thing, is the foreign operations of Citi Corp, and Citi Corp has euro as the functional currency. ABSPL is operating in country A. The local currency of country A is subject to hyperinflation. Hyperinflation means the inflation rate is, let's say, 200%, 300%, 500%. So you have Index 29, which talks about hyperinflation and how the accounting has to happen. Essentially, this is a situation of excessive inflation. So if the country A is plagued by excessive inflation, that means the value of the money is, is coming down very rapidly. Because if the let's say inflation rate is 200%. So the rate, even if the rate is 1 week apart, these rates will not be representative of. So, for example, if subsequent rate at 200% inflation rate will not be really reflective of the situation prevailing on a week earlier. That's what it says. As of 31st of December 2024, which is the measurement date, the relevant authority in country A prevents entities for obtaining foreign currency for the same, realizing the net investment. That means in country A, for the realization of net investment, exchangeability doesn't exist. However, last point. However, with effects from 30th April, that means 4 months from here, 31st of December is your the year-end date or the measurement date. But with effect from 30th April, which is 4 months from the date of measurement, the said regulatory authority allow entities to obtain the foreign currency for realizing even the net investment in the foreign jurisdiction. That means what? What the restriction was there as of 31st of December, that restriction have been lifted as of 30th April, 4 months later. Now, clearly, given this fact pattern, as of 31st of December, exchangeability doesn't exist. Because for the purpose for which the foreign exchange was needed as on 31st of December, that is realizing net investment, that doesn't exist. So therefore, you have to move to step 2 to estimate it, because step 1 fails. So how do you go about applying step 2? Now you have to look at again, the two parameters which we talked about, that inflation rate, whether hyperinflation or not, and the time gap when the exchangeability is restored. So in this case, the Citicorp will need to estimate the spot exchange rate. And how do we do that? So Citicorp is required to assess the first subsequent exchange rate, which is available only after 4 months, whether it meets the objective of paragraph 19A. Now clearly, these two factors which we already saw in the previous slide need to be evaluated. What is the time between the measurement date and the date when the exchangeability is restored? In our case, it is 4 months. And inflation rate is very excessive inflation rate, because the economy, country A, is characterized by hyperinflation. And therefore, in this case, clearly, you can't use this rate which is subsequently available, because that does not reflect the situations prevailing on 31st of December. Because the estimation objective is that the rate which you use should be reflective of that exchange rate which is on the date of measurement. Now in this case, clearly because of the fact that you have a long 4-month period involved and the economy is subject to hyperinflation, the exchange rate which is available on April 30th does not reflect the economic conditions at the measurement date of 31st of December. Therefore, in this case, the first subsequent exchange rate does not meet the objective of paragraph 19A for the purpose of realizing Citicorp's net investment. And therefore, you can't use that rate. Okay? So therefore, Citicorp can adjust that subsequent exchange rate as necessary to estimate. You can't use that rate, but you have to adjust it to estimate. Of course, the same rate which is available, you can't use it, unlike the example which I gave in the previous case. But you can use that rate as a starting point and then estimate the spot exchange. That you can do, provided that estimated rate meets the objective of paragraph 19A. Again, I have given the source from where this case study have been taken. Now that with this, we conclude our discussion for today. Yet, as I indicated, we are yet to discuss these 3 points. Now, with all of these changes coming in, who is going to be impacted? Who is going to be impacted by these amendments or likely to get amended? What are the additional disclosure requirements which apply? If an entity applies these amendments, what additional disclosure requirement it will have, and what it will additionally require to disclose in the notes, and what is the effective date from when this amendment is applicable. So this is something which we will cover in the next video. So series will continue, and possibly we will close the series in the next week's video, and that should be the last of the video in this series. So the 5th video in the series is likely to be the last video in this series. Thank you for all your support. Here is the list of some of the important and the useful videos which you may leverage. As mentioned earlier, please do support the channel in terms of subscribing, liking, commenting, so that I also get motivated by the fact that yes, it is something which is helpful from your professional perspective. Okay, so I'll take a pause at this point in time, and will maybe connect with you in the next week's video. Thank you. Bye for now.